I've got 10 new trading ideas to share with you today, including 2 potential home run trades that I'll be keeping a very close eye on. Hey guys, my name is Akil Stokes. I'm a Forex trader and a trading coach over at tier1trading.com. And this is the Trading Edge, my weekend preview where I take you around the market, show you the best opportunities on my radar for the week ahead, and sprinkle in all types of awesome educational lessons that hopefully will help push you along the path of becoming a consistently profitable trader. Now, before we forget, hit that like button, hit that hype button if you're one of the first ones watching this, and let's learn to trade. Gold had a massive week, rising over 7%. In start due to the US versus Iran news and ending with the dovish dollar reaction that came after Friday's underwhelming non-farm payroll report. Now, I do have a warning about gold that I'll hit you with a little bit later, but as far as the technical goes, we have both 1, price action running into a previous level of structure, and 2, price action completing an advanced pattern formation. In both cases, looking for short-term selling opportunities at this level would fall right in line with what I think a lot of traders may be looking to do. 1, you do have traders who rode this wave up throughout the week and they're looking to do a little bit of profit taking from their weekly gains. And 2, well, the newer bulls, they're not going to buy at this expensive price. Rather, they would wait and see if the sellers can take a little bit of the momentum back and look to reload for future buys at a much cheaper level. All right, so let's mark this thing up. So if we just take a look at our most recent swings in the market, swing high to swing low, a little swing low to swing high to swing low to swing high, followed by our swing high to swing low, you're going to see that price is coming right back to a previous level of structure resistance. Not only did we find previous level of structure resistance right here, but if we look to the left, that previous level of resistance was actually a past level of support. This is called something called an ice zone, where if you can imagine that box that I drew out being like the ice that's on top of a frozen lake, what it does is provide support for anything that's walking on top, right? Not allowing you to break through. And at the same time, it provides, if I can find a little fish here somewhere, I don't know if I'm going to find one. It provides, come on, here we go, resistance for anything underneath trying to break to the upside. And when you can identify these types of levels in the market, these are pretty important levels, and we typically see some reactions at that level. So we do have price action coming into that level, which is why I expect to see some relief here on gold. We also have an advanced pattern formation forming as well. Let me just delete my animals and I will draw it on. This particular advanced pattern formation is going to be called the bat pattern, and I'll show you why in just a bit. But it starts with our directional move down, our swing high to swing low right here. Then our next step is going to be our retracement. Now, what makes this a bat pattern is the depth of this B retracement. If I take my Fibonacci retracement tool on and drag it from the swing high to the swing low right here, you're going to see that our retracement comes to a 50%, but does not hit the 618. If it were to hit the 618, it would be a Gartley pattern that we would have on our radar, but because it doesn't, we're going to be looking for what's called a bat pattern, and that's going to complete at a very specific level. Our bat pattern is going to look something like this: swing high to swing low, X to A, first retracement, A to B, failed extension, B to C, and if price comes up to our 886, which we already did, that is going to be the completion point for our bat pattern, and this zone from the 886 up to the high of our X leg, pretty much the same zone that I drew out before where we had our nice little animals on there. That's going to be the completion zone for our bearish bat pattern. And remember, when it comes to advanced pattern formations, we're not looking for a full correction in the trend and for price to go into a new trend. Rather, we're just looking for a short period of relief. Now, to the warning I told you about earlier, 2 things we need to be aware of when it comes to gold as we get ready for the week ahead. 1, although these Iran peace talks, which is something that is driving gold, are getting close, and I'm doing this in big old air quotes, I feel like we've heard this a million times over the last 5 months, and well, we're still doing the things over there. So any changes of those plans would certainly affect gold. 2, with the dovish US dollar, so the weak US dollar reaction due to the non-farm payroll, the market is now pricing in a less than 50% chance of a rate hike in September due to the job situation. However, the much more important metric that's going to dictate future monetary policy is going to be the inflation numbers, and we get a big one this coming Wednesday in the form of CPI. So that release should have a major impact on the markets, specifically with the dollar, but also flowing over to gold as well. Speaking of relief, after a great start to the week on pretty much all of the indexes out there, we saw the Dow Jones give us a little bit back as we ended the week. You can see this big green candle right here, but with the wick of this candle being to the upside, that shows us the extreme, so the highest that price went throughout the week. And the close, which is a little bit lower, shows us where we closed the week, meaning that price did not stay at its highs. As we go down to a daily chart, we get a different visual of this as well. You can see a nice little pin bar here at the top showing us rejection, followed by a strong bearish engulfing candle right there. So here's what we're looking at the Dow Jones. From a technical perspective, we are still in a very bullish trend. One of the ways I teach trend to children and very, very new traders is to simplify the process, right? Look at the screen. If price is moving from the bottom left to the top right, we are in a bullish trend. If price is moving from the top left to the bottom right, we are in a bearish trend. And I say that jokingly, but seriously, sometimes common sense is the best sense that we can have in the market, because the more we learn, the more we overcomplicate things, and then our brain gets all clouded and weird. So keep things simple. But from a more technical perspective, and I guess a rules-based way of identifying a trend, one of the rules that we teach over at Tier 1 Trading is paying attention to the violation of structure. So if I look at my previous structure high, it's going to be this level right here. And as soon as price broke and closed above those highs, what that does is it validates the bullish trend, meaning that we are still in a bullish continuation state. Now, we know that trends don't last forever. The trend is your friend until it bends, right? So we do have periods of relief. And if you are someone who is looking to get involved on the potential next move higher, well, a period of relief is exactly what you're looking for, because that's how you can get involved at a cheaper price. So where is price action likely to pull back to? From a bigger macro sense, from our technical rules-based perspective, the first place that I would expect price to pull back to is our previous new structure high right around here. And that zone will go all the way to our previous outside return, which is our low right here. So this is essentially the zone in which I'm looking for a potential reversal to happen. Now, as we go down to a lower time frame, the 4-hour, we're going to get a little bit of a clearer picture of what's going on. And this is an interesting concept, right? So price action has currently or recently extended and then pulled back. And this is something that tricks a lot of traders. A lot of traders understand pullbacks. They understand that the market extends and then it gives periods of relief, right? And then it extends again. But what they don't understand necessarily is that that pullback doesn't have to be a single move. Sometimes, and often, I would say, that pullback comes in the form of multiple moves. And this is something called a complex pullback. And this is exactly what I'm looking for here. If I had to pinpoint an area of interest that I would like as my first place to get involved in the market, yes, it would be a retest of our previous new structure high right here. But if I look even closer at this elephant candle, so this big green candle right there, and I take a look at the consolidated zone before it, this is a level that really stands out to me as well. And if we were to get a complex pullback, let's just measure some things out and see where it would occur. And we can do this in two ways. One, we can take an equal measured move. So if I take the length of our first pullback, the swing high to our swing low right here, and I simply copy and paste this, there we go, and drag it on to the little bit of a retracement we had already, boom, you can see price is going to come right down into that zone. Again, these things aren't 100% perfect, so you got to take it with a grain of salt, but you can see that equal measured move, that harmonic move is right in that area. We can also take our Fibonacci extension tool from that same move, that swing high to that swing low, and see if there's any type of Fibonacci confluence at that level as well. Boom, lo and behold, we have a 1618. So we have a few things happening here. We have an AB equals CD pattern, or a one-to-one measured move. We have a 1618 Fibonacci extension, and well, we're in that bigger kill zone. So as we start the week, if we do get a little bit more relief here on the Dow Jones, don't necessarily get afraid and think that a bearish trend is happening. Just think it's an elongated pullback and still an opportunity for potential buys. Now, one more thing that I would find very interesting, and again, not trying to project the future here, but if we see this, this would be kind of cool, is to see what happens here on the RSI. So the indicator that I just blew up is called the RSI. It's the Relative Strength Index. It is my favorite indicator. It's not the best indicator in the world. There is no best indicator in the world, but it is the best indicator for me, or the favorite indicator that I like to use. And I use it in a few ways. I use it for overbought and oversold conditions. I use it in order to kind of determine the direction of the market. I also use it for divergences. And a specific way that I use it for divergences are a way called hidden divergences. And essentially what hidden divergences are is they are signs of potential trend continuation trades. So if I'm going into the future and looking at this, if price were to push down here, there's probably a good chance that our RSI will follow and go down here as well. After all, if there's a lot of selling momentum in the market, we should see a lot of bearish action on the RSI. Keyword should. If we are able to push down there and let's say we go oversold, we're going to have a very interesting setup because we're going to have the RSI dip lower than this previous low right here. Yet on our price chart, this low is, well, much lower than our previous low over here. And this is something called hidden divergence. Essentially, it's when your price chart and your indicator are showing you two different things. This signal specifically would be another positive sign for a trend continuation. So not saying it's the greatest signal on earth, but following up on the CTS lesson that I gave you the other day, where we're taking different bits and pieces of information and putting them together to find high quality trading opportunities, this is certainly something that could be added to that equation if you're looking for trend continuation scenarios. Oh yeah, almost forgot. As far as targets go, yeah, look to buy this up, look for a retest of the highs, look for an extension, because after all, this is an index and indexes historically go bullishly. So if you can ever get a trend continuation opportunity on an index, I like to hold and see how far that train will go. Next up is the pound Aussie, and this isn't really a popular pair, but this is a really fun trading opportunity on a few levels. And I'm going to start here on the weekly just to paint the picture before we dive into the dirty little details of this setup. On the weekly here, let's go through our four-step process. IPDE, identify, predict, decide, execute. So the first step I want to do when I analyze a chart is I want to identify what price action is doing. And forgive me, I'm going to kind of take you through my internal dialogue because I am a trader, and yes, I run live rooms and I work with traders on a regular basis, but I also do a lot of my work solo. So yes, I do talk to myself. And don't worry, my doctor says it's completely normal. So the thought that goes to my mind is, hey, Akil, what is price action doing? Where has price action gone? And if I look at the very last move we had here on the pound Aussie, I can see that price action has come to a previous level of structure, right? We had this nice collapse from, what is this, 216.80s all the way down to about 184.82s. And we can see that at that level, we had previous structure support that held, we had previous structure support that held, and price came to that level and pretty much started reversing. Now, this isn't your normal type of reversal. This is actually a complex reversal, which features a classic pattern formation called a head and shoulders pattern. Because if we look at this from a different perspective, we didn't just put in a V bottom, right? What we did was this. We dove down and then we retraced a little bit. And then we extended a little bit further down and then we retraced a little bit further than last time. And now to complete our head and shoulders, we would need this little bit of a failed extension to the downside, followed by a violation of this neckline, and that would finalize the move. That would allow us to predict that price is likely to continue higher. And yes, for you guys that are still stuck on divergence, yes, we do have some pretty nice divergence coming down here as well. In the previous setup, we took a look at hidden divergence. This is called regular divergence. I don't have a lot of real estate to draw it out, but you can see the left shoulder and the head puts in lower lows. If you look at our RSI, the area where we had the left shoulder and the area where we had the head are not putting in lower lows. They are putting in higher lows. Divergence, again, when indicator and price are doing different things, that's when we pay attention. So I want you to keep that head and shoulder, current right shoulder idea in your brain somewhere, because we're going to dive down to the lower time frames and inquire about something else. So let's go down to the daily chart, right? And as we zoom in our charts here on the daily, we've got something else cool that is setting up, and that's going to be an advanced pattern formation. So just like last time, we're going to start with an impulse or an anchor leg, so a clear directional swing low to swing high in this case. And I think we can all agree this is a move that comes off a retracement, and then we extend up a clear directional swing. Step one. Step two, I want to take my Fibonacci retracement tool. I want to drag it from the low of that swing to the high of that swing. And I want to see which Fibonacci level is hit as the market retraces. Now, in the example of gold, I think it was, we had a bat pattern because price action came to the 50% level and did not hit the 618. In the case of the pound Aussie, price action comes past the 50%, but does hit the 618. And what that means is that we are not on alert for bat pattern. It invalidates it. Get out of here. We are now on alert for what's called a Gartley pattern. Now, there are many different ways to trade Gartleys. The way that we teach it over at Tier 1 is using a 127 extension as our D prediction. So I'm going to take my Fibonacci extension level from our swing high to our swing low right here. That's going to give me a 127 extension that should sit right on that 786. Bang. That's just how Fib math works. Should sit right on that even handled number, 189 as well, which has nothing to do with Fib math. It's just kind of cool that's down there. But if we put it all together, it looks something like this. X to A, swing low to swing high, A to B, B to C right here, and a CD completion right here at our 127, with our zone of completion going from our 127 to our X leg. Now, before I spoil it, can anyone guess where I'm going here? Why did I show you the higher time frame and then show you the lower time frame? Is there perhaps a connection that could be made? Well, if we take a look at a buying opportunity right here, and if I just go back out to my weekly chart right here, remember we spoke about the right shoulder potentially forming. You can't see it because I got too much junk on there. But what I'm trying to say is this. If you are an aggressive head and shoulders trader who likes to trade the right shoulder versus waiting for the completion of the pattern, which would mean the violation of the neckline, well, this potential bullish Gartley is your way in. You can see our completion zone comes at a symmetrical level to the left shoulder. That buying opportunity would put you in at the right shoulder and give you the opportunity to get in well in advance of this head and shoulders. Now, with that being said, remember, the head and shoulders technically isn't validated until the neckline is broke. So maybe it's cautious Akil speaking, but I personally wouldn't put all of my eggs in this basket. Rather, I would break it up some. So the way I would approach this is like this. I would take the Gartley pattern because I am a Gartley trader and that's what I'm supposed to do anyway. But instead of taking a traditional target 1 and a traditional target 2, what I would do is I would take a traditional target 1. And if you're feeling like you want to catch that bigger ride, instead of taking your traditional target 2 off, looking to play that target 2 for the higher extension, or put on a third position. That way you can take off target 1 at a normal location, target 2 at a normal location, yet you still have some skin in the game just in case that big move happens. And I'll tell you what, the more experience you have in trading, the more you'll realize that the really big winners are few and far between. I know the internet glorifies them and gets you all excited about them, but the honest truth is that trading looks like you win a little bit, you lose a little bit, you win a little bit, you lose a little bit. But then every once in a while you catch that big win that just elevates you to that next level before you go back to winning a little bit and losing a little bit. So when you can find opportunities like this, we call them home run trades, that have that potential, it's certainly worth having some exposure to, because a few of these a year, and we saw this earlier in the year with my pound yen trade, well, this can make your trading year. On the other hand, just on a side note, what a lot of traders do, and this is why a lot of traders lose, is instead of win small, lose small, win small, lose small, win big, they win small, lose small, win small, lose small, something psychologically happens in their brain, lose big, and then spend the rest of their year trying to dig themselves out of that hole. If you look at the maximum drawdown recovery chart, you'll see exactly how hard it is to dig yourself out of a hole once you get into it. Pretty much, if you lose 50% of your account, which you should never do, you've got to get 100% back just to be at break even. So you have to massively outperform what you're capable of doing just to get your head above water again, not even make profit. So yeah, you probably want to take the route that I told you about. Speaking of head and shoulders, we're going to head to another head and shoulders that we've looked at for the last 3 weeks on the New Zealand dollar. But what's interesting about this is what happened after the head and shoulders, right? So this was the head and shoulders pattern. I'll draw it on once again because I know people are new each and every week. Thank you for joining, by the way. Make sure you like and hype this video up, subscribe, that way you don't miss this weekly video and all the other cool gems that I put out throughout the week. But we have a head and shoulders that looked like this. And this was actually one that I gave you guys a warning about. I said, be careful of this sneaky little level of overlapping structure right here, because this is the true level that needs to be violated. And that is still the case. But if you are a trader who is not worried about that level, what we have here is something very interesting. After we've moved up from the right shoulder, we've put in this sideways shuffle of consolidation. And although here on the daily chart, it looks like complete junk. We call these railroad tracks because, the bars are just going back and forth like railroad tracks. But this is actually a very high quality pattern called a high and tight flag. And we'll see that a little clearer as we go down to the 4-hour time frame. So price has our directional move right up here. That's going to be our flag pull. Then we just have this channelization going back and forth, which represents our flag pattern. So traditionally, this is a bullish breakout pattern, right? The fact that we have broken and closed above our previous level of structure right here is a positive. Again, we have this sneaky level here on the 4-hour, which we did close above as well, which is another positive. So my expectation is a break to the upside. Now, there are 3 ways to trade this pattern, and I'll explain that in a little bit. But first, I want to talk about target projections, because this is important. Whenever we analyze a trade, right, we need to make sure that that all the puzzle pieces connect, meaning that every requirement is met. Something that gets a lot of traders in trouble is when they look at only a portion of the setup. So something has a great profit potential. So it's like, yay, let me get involved. Or something has a very small stop loss, like, yay, let me get involved, right? The truth is we need to look at entry, stops, and targets all at the same time, because that's how we create our risk profile. So something I always ask myself when I'm trading is there room for me to actually make profit? Because if there's not, there's no point in trading. So that's a question that you have to ask yourself, right? If price action is likely to explode up from this pattern, where are we likely to explode up to? And for me, it's a little iffy. And again, keep in mind, I'm a very conservative trader. If I just take a look purely at structure, I see another zone of consolidation right here, which is technically above our flag pattern, but not above it enough to make any relevant profit, especially considering the risk that I need to take on. Something else I can do is I can bring in our volume profile to see if this is indeed a level that I should pay attention to, or if this is a level that I can ignore. And again, the volume profile tool pretty much shows you levels of interest in the market. At least that's how I interpret it. And if you're not familiar on how to use it, I'll link a video that I did on showing you that in the description box below. But if we bring our volume profile on, we don't have a lot of volume anywhere to the upside, but you can see that we do have our next biggest spike right in the middle of that zone that I drew out. So For me, that would be a target projection. Now, if you don't care about that, the next target projection would be 60 cent even, or a little bit below that, I should say, right at our previous level of structure right up here. So the question you need to ask yourself is, do I have the ability to trade it from here to here? Is there enough profit potential? And this may dictate if you can take the trade. This may dictate how you can take the trade, because there's only about 20 pips or so from the highs to that level. So with that being said, let's talk about the three ways to trade a breakout. There is the before, there is the during, there is the after. So the before is going to be this. If price action were to trade back across this channel, let's say to the lowest low, right? Because this would be a good level to get involved in. What you would want to do is you would want to establish your position at the lower end of this range and pretty much anticipate the potential breakout. And this is going to give you the best profit potential, because I can tell you what, if you're getting involved in a trade, let's say down here somewhere, whatever your reason for entry is, and your stops are right underneath the lows here, because that's all you need to be in order to know that you're wrong, well, you can easily look for that move back up and have an amazing risk reward and get some pretty good pippage out of it as well. So the before is certainly an option. Now, keep in mind the downside that comes with the before, because there's a give and a take to everything, is the fact that you have no proof that the breakout is likely to break out. So you're kind of anticipating it pretty much. The during is going to be a little bit different. The during would be trading it to the upside while the breakout is happening. So using something like a buy stop order right here. And as price action breaks to the upside, you're getting filled to the upside as well. Obviously, there's going to be a lot less profit potential. It's going to be hard to tell if you can get a positive risk reward or not. It's probably going to depend on what your stop loss method is and what type of candle it looks like that breaks out. But I would classify it as something that is doable, maybe. Again, it really depends on the uniqueness of the situation. The after would be waiting for the confirmed breakout, so the break and close above this range, and then looking for the pullback back into this range, and then looking to get involved that way. And once again, you can see if you're taking that route, you should be able to get decent amount of pippage to that level, and you should be able to get a decent risk reward, whether you're putting it below the range of the candle or if you're putting it below the entry technique specifically. So something to look at here with the New Zealand dollar, 3 ways to get involved. Oh, Canada, let's go back and visit you, because last week we spoke about where price action would go to if we were to go lower. Now, I want to do one more thing as well here. I want to take a Fibonacci inversion of this latest retracement. So I'm going to take my Fibonacci extension tool again, but this time draw it backwards from this swing high to this swing low right here, and back up. And I just want to see, yep, look at that. I have a 1618 inversion lining up right with that 127 extension. And that's going to come right at the upper zone of this inside level of structure. So I do think that's a good level to shoot for. It's also right above the one. And lo and behold, we came right there, right? Look left, structure leaves clues. I know the internet tries to bash structure trading because it's not flashy and fancy and there's all other types of stuff they're trying to sell you. But this type of stuff has worked well before charts even existed. So that should tell you everything you need to know about the power of structure. It's crowd psychology, human behavior, like that doesn't change. So now that price has come to that magical level, let's talk about what to do next. Because despite the big black candle, the big bearish candle here, I don't want to be bearish because we've come to the level that I've expected us to come to. So this is where my counter trend trading brain flips on and I start looking for potential buying opportunities. So let's hop down to the lower time frame, the 4-hour chart. You can see that as we go down to the 4-hour chart, we had our big move for the day. Again, non-farm day, dovish reaction for the dollar. Everyone hates it. There's some Canadian tariff stuff going on as well. But we did get that move to the downside. We did get it in a sharp, steep, and direct way. And we got it right down to our previous level of structure. In fact, if I just take a look at this rejection zone right here, this black candle, it looks like we came, right to the tippy top of it and started testing it. Down on our RSI, our relative strength index, our RSI is also massively oversold, as it should be after a big bear move. But you can see it's starting to dip and hook right back up, and we may get a breach of that line early on this week. The point is, at this level, this is where I'm looking for a potential structure-based counter trend trading opportunity. And pretty much I'm looking for a correction, some relief back up. And there's two levels that really stand out for me. Again, conservative Akil. The first level that I would expect price to go to is right here, right? A retest of this structure shelf. We have a nice psychological number right there at $1.40, and we have structure looking left, support, support, support 3 times. Previous structure support should act as resistance. That's where I would expect us to go. If you want to be a little bit greedy, and I can bring some volume on to see what that looks like as well, I would say aim for this level up here, right? We talk about elephant candles, these big gigantic candles that stand out, and taking the consolidative zone before that. That's going to be about 140.20, but in all honesty, if you're looking at 140 compared to 140.20, I would personally take the safer route. But let me just see real quick, volume-wise, what we're looking like at this level. To swing high to swing low here, and yeah, pretty much you can see it all starts to get crazy and funky around the same area. So I would definitely take the more conservative route. So if you're looking to get involved, here's an aggressive way to go about it. Again, price has dove down, big bearish candle. We put in another strong bearish candle with a little rejection to the downside. And then we ended the week with what's called an inside bar. And an inside bar is this. An inside bar is a bar that completes, completely within the previous bar. So if I take the range of our previous bar, this is going to be called the mother bar. We can see our highest high is right here. Our lowest low is right there. And the full range of the current bar completes within it. Now, one of the methods for trading inside bars would be to place a buy stop order a little bit above the high of that inside bar. And as price action, or if price action breaks to the upside, it would get you filled. So if you're looking for a breakout to the upside, that is certainly a method that you can take. On the other end, your sell stop would be down here. It's going to give you a great risk reward. Now, again, do you want to be this specific with it? These are kind of the generic rules for an inside bar. Do you want to be this specific with it? Probably not. I think this is a very tight stop for a breakout. I'd rather at least get below this low right here. But again, just giving you ideas of how you can go about it. Like anything, you want to kind of take whatever method that you learn and customize it to your own liking. But this would certainly be a way to get involved in the trade if you're expecting corrections in the market to start the week. Following up on our breakout theme, I want to take a look at Euro Aussie. And this is an interesting one because price action has given us a double top, kind of, and I'll get back to that because I have some very specific rules for double top. So it's not one for me, but I know it's one for many of you. And then we've trickled down off of that to another one of those ice zones. So let's start off with the double top, maybe, right? Price action has put in a clear directional move up, swing low to swing high. We reached previous levels of structure. Look left, structure leaves clues. And the market decided to do a little bit of a pivot off of that and retrace back down. But, right, the bulls weren't going to be defeated that easily. And they said, hey, let's try pushing up again. They got some momentum. They were feeling themselves until the bears popped in once again and said, not so fast. Let's beat you back down. And this is where we're kind of trading at today, right? The bulls tried to make one more jump to the upside. They failed miserably, and we're pretty much hanging out around the lows. Keep that in mind for kind of the bigger perspective of how price has moved. Now the question is, where are we trading at, right? This is that IPDE thing. And if you were paying attention to the beginning of the video, you're going to see something very similar to what we mentioned earlier, right? I don't want to spoil it for you, but if I take this box and I just draw it out to the left and we take a look at support and support and support and resistance, this is going to be an example of one of those ice zones. Well done. I'm assuming you got it right and you did not cheat. So We're holding currently at a really important level of structure, a battle between the bulls and the bears. And what typically happens at this level is that whoever wins tends to win in a big way. Again, you can see the big breakout that happened here once the decision was made, the big reversal that happened here once the decision was made. So what I would be looking for at this level is a potential break. And this actually aligns with an alternative way of trading a double top. So in most cases, we look at a double top like this, and this is how I personally trade it. As price goes up, we then retrace. And then once we get to the retest and we prove that we've held, I like to sell right at the top there because that maximizes my profit. Another method, however, is waiting for confirmation of that double top. And this would be similar to how you would trade a head and shoulders, which means waiting for that V point to be violated and then look to trade it down from there, right? So instead of catching it up here, you're looking to catch it there. And this is exactly that. So if price action can violate this level, let me actually get it on a line right here, wherever this low is, right? The low of this red box, the expectation is that we should break out to the downside. Now, I told you earlier, this is not a double top for me. And the reason it's not a double top for me is because of the depth of retracement. The fact that we came down and retested a previous level of structure looking left invalidates it from being a double top. And again, I have some very specific rules that allow me to be consistent in the market. So it is what it is. I'm not saying you need to have those same rules. I'm just telling you how I analyze the market. But for someone who may have similar rules to me and you notice these double tops, but you can't technically trade them as double tops because they don't meet your rules, this can be an alternative way of getting involved in the form of waiting for that break. Now, the one issue I have with this trade, and this is why I didn't make the grade A segment of today's video, is similar to what we spoke about before. Something I want to make sure of when I have trading opportunities is there enough room for me to make profit? And when I ask myself the question, if price action is likely to go lower, then where is price likely to go lower to? My answer is, well, somewhere in this big old zone, right? I don't really have a key level of structure within that zone that stands out for me, right? Now, there are other tools that I can use here, but none of them are going to give me really an optimal level to shoot for. So let's kind of work through some of these tools. I'm going to start with a clean chart here. I am going to draw back on this big old zone so you guys can visualize it. So one thing I can do is this. We did this earlier. I can look at a harmonic move. I can take the length of this recent extension down and I can copy and paste that onto the recent retracement that we had and look for an AB equals CD pattern. That's going to put me all the way at the lows. That's certainly a method I can use. I can, and sorry, I'm always lazy with drawing these things on. It should be right here. I can tag team that with a Fibonacci extension. So Fibonacci extension from that swing high to that swing low down here and back up. And you can see we have a 1618 Fibonacci extension right there as well. So if you're looking for some Fibonacci influence, the very low of this structure zone is, well, a perfect level to shoot for. However, when it comes to my trading, I love harmonics. I love one-to-one measured moves. I love Fibonacci's, but they are secondary to structure. So whenever I'm picking a target level, unless there's nothing else available, it needs to be at a clear level of structure. And that's the part that I'm still confused about. So one more thing I can do is I can bring in my volume profile tool and I can see, is there any volume area that stands out amongst the rest here? And you can see that we have a big void right here, which is good if you're new to volume. Again, I look at volume as being synonymous with interest. The more it spikes out, the more interest there is at that level. The less it spikes out, the more I expect price to cut through it like a hot knife through butter. And after cutting through it like a hot knife through butter, you can see the volume starts to pick up a little bit a little bit more right at this 127 and right above our 163 even handle. So if I had to personally pick a zone that I would expect price to go to, it would first and foremost be right here, maybe with a secondary target down here. And the issue with that is well, is there enough room to go to the downside? And again, that's a question we won't know until we actually see the breakout. But if you're aggressive and you're using a sell stop order to get involved on the way down, there potentially could be. Or you can use the retest method where you wait for the violation, confirmation of the violation right here, and then see either on this time frame or a lower time frame if the market might give you a little bit of relief, and then look to catch that next extension down. That's my preferred way of doing it. But like I said, sometimes when you have these breaks of key levels, the market just goes straight there and it doesn't give you an opportunity to get involved. And hey, if that happens, that's okay. You just delete your drawing tools and you move on to the next opportunity. Speaking of the next opportunity, we're going to head to the euro dollar next. This is going to be a review from last week as we still have the same higher time frame pattern setting up, but we do have some different stuff happening in here, which we're going to take a look at. But here on the daily, we have a bat pattern that is nearly complete. I'll do this short since we're already probably like 45 minutes into this video already, but what we're looking at here is a swing high to swing low, X to A, our first retracement, A to B, our failed extension, B to C. And if we were to get to this 886, that would be our D completion, with our completion zone going from our 886 to the top of our X leg right there for a bearish bat pattern, so a selling opportunity. Now, if we dig down to the 4-hour chart, we're going to notice some pretty cool movement here in the market. Price has pretty much been putting in like a rising channel. So a formation that looks like this. Price has rallied up and then we've just slowly kind of drifted higher and higher, higher. And once again, right, we're going to bring in the D word, divergence. If we take a look at our price chart, specifically our most recent two highs, our high here, which is lower, and our high here, which is higher. And then we take a look at our indicator, which should be doing the same thing. Something is not like the other, as we have a high here, which is higher, and a high here, which is lower. Once again, that is going to be bearish divergence. It's not a full signal that price is going to go to the downside, but it is a pretty important clue that we can add to the equation. Now, I say that for two reasons. One, if you are a bat pattern trader, maybe that gives you a little bit of confidence in that trade, as it's often hard to sell into big green candles that are rallying towards your entry. But this can also be an alternative reason, or I guess a trade in its own right. Very similar to, what was the one with the inside bar? Gosh, very similar to, I think it was Dollar Canada. We can look for a similar situation here if you're expecting a sell. We have two back-to-back inside bars here on the euro dollar. We have an inside bar right there, and we ended the week with an inside bar right there. Same situation. If you are an inside bar trader and you're super aggressive, you can look to put a sell stop right here. Again, I would hide stops above the highs, just not above the inside bar there. And you can look for a move to the downside, meaning that you position yourself on the break or in the break to the downside if that occurs. And you can see you're going to have a beauty of a risk reward. Even if you're going with a retest of the lows right here, you get a 1-to-1. If you're playing that move lower, you get much more than a 1-to-1 as well. So a few opportunities to check out on the euro dollar. By the way, this wasn't on my list, but let's take a look at the dollar index real quick, just because, well, you may not notice, but the dollar index is pretty much just the euro dollar flipped upside down. So we actually have an advanced pattern formation that is completed there. Pretty much exactly the same thing as the euro dollar, except this one actually came down to hit the level where the euro dollar is still waiting for that level to be hit. By the way, if you're curious of why the dollar index looks like the euro dollar, and also why I don't think the dollar index is a good tool to use for any type of correlation or judgment of strength in the market, well, it's because the dollar index is, I think, 60 something percent. If not, I don't know if it's, I forgot if it's over 60 or right below 60, but let's just call it 60. I'm sure I'll bring up a chart you can see. It's 60% weighted by the euro dollar, which pretty much means the dollar index does what the euro dollar does, unless there's weird stuff that's happening somewhere else. So there we go. Food for thought. The next time you try to use the dollar index to judge dollar strength or weakness, don't do it. You're really just judging the euro dollar strength or weakness. Here's a free lesson for you. Speaking of free lessons, if you're a podcast person, I do host a podcast. It's called the Trading Coach Podcast. I release 3 new episodes each and every week. It's available on your favorite podcasting app. Make sure you check it out and get more free trading lessons throughout the week while you're waiting for this weekend video to arrive. All right, time to enter the lightning round. We're going to run through the rest of these pretty quickly and try to keep this video under an hour. But I can't believe I'm doing this, but we're going to be looking at pound yen, and euro yen is actually very similar. They're pretty much the same as most of the yen pairs are after the intervention. But what I would be on alert for here is the same thing that we took advantage of last intervention, and that is retest of key levels of structure, right? If we take a look at the previous intervention, this was back here in April 30th, May 1st, somewhere around that area. You'll see that price action consistently came to a very specific level and bounced off. You don't have to go back to the former videos, but you'll remember we saying this was easy pickings, right? The market was clearly protecting this level and it showed it multiple times. Just take a look at the wicks down here. And, not to oversimplify things, but as the market proved that it wasn't going to allow the yen to strengthen past this level, it made for some very easy, quotes, right, trading opportunities. And we could be seeing the same thing here. Price gave us our initial dip after the last round of intervention, and price attempted to dip a little bit lower today. And I don't necessarily think this is a good buying area right here, but I would say this. If price were to once again retest these lows and prove, and I don't have the camera up today, but I'm yelling at you in your face, it's very important in my opinion that you wait for proof because you don't want to get caught on the wrong end of this. If it were to prove that it were to hold by, again, putting in these long wicked candles showing us a bullish rejection, these would be good opportunities to buy. And essentially on a bigger time frame, you're looking at buying double bottoms. On a lower time frame, you're looking at kind of like different type of probes and maybe higher high, higher closes. So again, nothing that's necessarily for this week as I don't know what's going to happen. But as you track these yen pairs going forward, pound yen and euro yen are my 2 favorites that have these setups going on. Price action came to pretty significant levels of structure, the same levels of structure that we saw during previous interventions. And once again, the yen has yet to prove that it can maintain this strength. So until it does, I think traders are going to buy those dips each and every time as cheap price points. Next up, we're going to be on the Aussie, Canada, and Tier 1 members. This one is for you, as I've seen this circulating around the chat for a very long time now. But we know the Aussie Canada takes forever. We also know the Aussie Canada likes to consolidate, and we're back in consolidation, which is lovely for pattern traders, right? Ooh, X to A to B, B to C, B to C is beautiful, right? If we can continue lower, we have a potential cipher pattern forming here. Our swing low to swing high is going to be our X to A. Our retracement right here is our A to B. Our extension higher is our B to C. And if we can push down past this B leg down to our 786 Fibonacci level, that is going to be the decompletion point for our bullish cipher pattern. And as I mentioned before, Aussie Canada is finally back to doing Aussie Canada things, which is just shuffling sideways. This is great for advanced pattern formations as they tend to form during periods of consolidation. And if you want to take it to the next level, maybe you're a channel trader, maybe you get a little bit more aggressive with this and look to trade it back across the range. Another short and sweet setup for you is going to be a potential Gartley pattern here on the pound New Zealand. This is going to be relevant either on the 4-hour or the hourly time frame, whatever is your preference here. I'll just measure it out on the hourly so I don't feel like bouncing back and forth. But we have our initial swing low to swing high right here, which is going to be our X to A. Our first retracement is going to be our A to B. We want to bring out our Fibonacci retracement tool and confirm that it hits our 618. Indeed, it does. I'm going to take my Fibonacci extension tool and drag it from the swing high to the swing low. I apologize for moving fast, but I promised myself I would try to keep this video under an hour. And me talking isn't helping that. So all in all, it looks like this. We have an X to A, swing low to swing high, A to B, B to C up here. And if we were to push down to this 127, that would give us a decompletion for a potential bullish Gartley pattern. Like this video before you go, hit that hype button as well. That way YouTube spreads it around the world and we impact more traders. Also, if you got a little bit confused because we spoke about a lot and you're looking for a way to kind of organize all the things that you are learning, check out this free 30-minute lesson I did on the CTS trading system. All right, I'll see you guys next week for another Trading Edge video, and keep an eye out for a cool day trading myth buster video that I have for you guys as well. All right, until next time, plan your trade, trade your plan. Take care.